Welcome to our podcast. We are delighted to have you here in our community of learners. If you're ready to dive into the world of economics and finance, this is the place for you. Together, we'll explore the concepts that shape our financial decisions and impact our daily lives. If you love engaging educational content, make sure to subscribe and join us on this enlightening journey. Today, we embark on an exploration of two important fields, economics and finance. While they often overlap, they serve distinct purposes in understanding how the world of money works. Let's begin with economics. Economics is the social science that studies how societies allocate scarce resources to meet unlimited wants. We live in a world filled with desires and needs, but our resources, whether it's time, money, or materials, are limited. This is the crux of economics, the study of managing these resources wisely. We'll examine how goods, services, and resources are produced, distributed, and consumed at the societal level. Economics looks at the big picture. For instance, when discussing the production of goods, we consider various factors: how they're made, who makes them, and how they reach consumers. Understanding this helps us comprehend the overall flow of economic activity in our communities and beyond. Now, let's shift our focus to finance. Finance, on the other hand, zeroes in on the practical aspect of money management. It deals with how individuals, businesses, and organizations manage their finances, encompassing everything from saving and borrowing to investing and managing financial risks. You see, while economics sets the stage for growth and production, finance is what drives us through our personal and professional financial decisions. The relationship between economics and finance is both intricate and enlightening. Economics provides a framework that helps us understand the complexities of economies. In contrast, finance applies these economic principles in real life, make decisions about money, assess risks, and determine value over time. It's like economics is the map of the land, and finance is the vehicle that helps you navigate through it. Through our daily lives, we all engage in finance, whether we realize it or not. Think of personal finance, which involves managing how we earn, spend, save, and invest our money. For instance, budgeting is a crucial skill that helps families manage their finances effectively, allowing them to plan for future expenses. On a broader scale, corporate finance is about how businesses juggle their finances. Companies need to raise capital, invest that money wisely, and manage the risks that come along with financial decisions. It's a balancing act that is essential for maintaining a healthy business. Now let's think about how broader economic conditions affect our financial choices. Economic indicators such as inflation, interest rates, and unemployment play significant roles. For example, when inflation rises, it means the prices of goods and services increase. This decrease in purchasing power affects how we save and spend our money. If you've ever felt that your money doesn't stretch as far as it used to, you're experiencing the effects of inflation firsthand. Interest rates are another important aspect linking economics and finance. Central banks, like the Federal Reserve in the US, adjust these rates to impact economic activity. Higher interest rates mean borrowing becomes expensive, which can lead to reduced spending and slower economic growth. Conversely, when rates are lowered, borrowing becomes cheaper, which can spur economic activities. But how do these changes directly affect you? A regular household may find that higher interest rates mean paying more on loans, while lower rates allow for cheaper mortgages or student loans. Now, let's bring another major economic factor into the discussion: unemployment. High unemployment, which is measured by the percentage of the labor force actively looking for work but unable to find jobs, can lead to economic hardship. For many families, this translates to decreased household income and increased stress. It's particularly difficult when you consider saving for future goals, such as buying a house or preparing for retirement. When job numbers are low, many struggle to manage their finances effectively. A crucial concept that bridges both economics and finance is the time value of money. This principle implies that a dollar received today holds more value than a dollar received in the future. Why? Because today's dollar can be invested, earning returns that exceed its future value. This is why we emphasize the importance of saving early. The sooner you save, the more time your money has to grow. Next, let's talk about central banks. These institutions, such as the Federal Reserve, are vital players in managing a country's money supply and interest rates. By utilizing what is called monetary policy, they can influence economic conditions and stabilize financial markets. For example, during economic downturns, central banks might lower interest rates to encourage spending and borrowing, which can help boost the economy overall. Lastly, let's reflect on how economics and finance integrate into our daily lives. Everything we encounter, whether it's the price of groceries, the interest rate on our savings accounts, job availability, or the cost of education, has its roots in economic principles and financial systems. They affect our choices and opportunities every day. As we continue to learn about these concepts, remember their relevance. Understanding economics and finance can empower you to make informed decisions. Whether you're budgeting for a special gift, planning for higher education, or investing for your future, these principles will guide your choices. Today, we covered a wealth of information about economics and finance, highlighting their vital differences and interconnections. We learned how economics helps us understand the allocation of scarce resources, while finance focuses on managing financial decisions in our lives. We explored the significance of economic factors such as inflation, interest rates, and unemployment in shaping our personal finances. The time value of money was another key takeaway, emphasizing why saving early can have lasting benefits. Finally, we discussed the role of central banks in maintaining economic stability and how these concepts play a crucial role in our daily decisions. By understanding these connections, we become empowered to navigate our financial futures wisely. Thank you for joining us today. We hope you enjoyed this exploration into the intriguing world of economics and finance. Remember, understanding these concepts is not just about learning, it's about applying that knowledge to make informed choices. If you found this episode valuable, please subscribe to our podcast and share it with friends and family. Keep pursuing knowledge, and we'll see you next time.